Ever wondered how to make sense of the stock market? Well, it all starts with understanding stock research. You see, stock research is like a compass, guiding investors through the vast ocean of financial markets. It can seem daunting, but fret not. We're here to break it down for you. Imagine you're an explorer, and the company you're researching is a new land. Your first stop? The company's annual and quarterly reports. These documents are like treasure maps filled with a wealth of information. They'll give you insights into the company's financial health, performance, and future plans. But here's a tip. Don't just look at the numbers. It's easy to get lost in the balance sheets and income statements, but you need to also understand the story behind those figures. What's the company's business model? How does it make money? What's the quality of its management? Who are its competitors? These are all crucial pieces of the puzzle. Speaking of competition, it's important to understand the company's standing in the market. Are they a leader or a follower? How do they stack up against their peers? This is where comparative analysis comes into play. It helps you to see the bigger picture, to understand industry standards, and to gauge market sentiment. Now let's talk about management quality. A company is only as strong as its leadership. So look at the track record of the management team. Are they experienced? Do they have a history of making sound decisions? Remember, a strong management team can steer a company towards success, while a weak one can lead it to failure. To wrap things up, remember that understanding stock research is like learning a new language. It may seem overwhelming at first, but once you get the hang of it, it becomes second nature. So dive into those annual reports, dig into the management team, and scrutinize the market competition. Remember, understanding the company and its market is the first step towards making informed investment decisions. So get out there and start exploring. Now that we know how to research a company, let's talk about peer analysis. Peer analysis is the process of comparing a company's financial metrics with those of its competitors. To get started, you'll want to identify a set of competitors in the same industry, with similar size and market cap. Once you've got your set, it's time to compare key financial ratios. Look at the price-to-earnings ratio, return on equity, and debt to equity. These ratios can help you gauge a company's profitability, financial health, and risk level. But don't just look at the numbers, visualize them. Using visualization tools can provide a clearer understanding of how these metrics stack up across companies. A great resource for peer analysis is Professor Aswath Damodaran's website. His extensive data on various industries and companies can be invaluable for comparative analysis. Remember, a quick comparison with peers can often reveal valuable insights about a company's standing in its industry. Moving on, let's delve into the basics of discounted cash flow or DCF analysis. This method, quite popular among financial analysts and investors, is a valuation model that seeks to determine the value of an investment based on its future cash flows. At the heart of DCF analysis lies the concept of time value of money. What does it mean, you ask? Well, it's rather simple. $1 in your pocket today is worth more than the same dollar you would receive in the future. Why? Because the money you have now can be invested to earn a return, making it more valuable than the identical sum received in the future. Now, how does DCF analysis work? It starts by estimating the company's future cash flows. These cash flows are then discounted back to their present value using a suitable discount rate. The sum of these discounted cash flows gives us what we call the intrinsic value of the company. But here's a word of caution. When estimating future cash flows, it's always wise to be conservative. Over-optimistic projections can lead to overvaluation, which can, in turn, lead to poor investment decisions. Remember, it's always better to err on the side of caution when it comes to your hard-earned money. So what role does the discount rate play? The discount rate is essentially the rate of return required by an investor. In most cases, this rate is the company's weighted average cost of capital, or WACC. Choosing the right discount rate is crucial as it significantly impacts the outcome of the DCF analysis. In essence, DCF analysis is a powerful tool in gauging a company's intrinsic value. However, like all tools, its effectiveness lies in its correct and prudent use. It's not a crystal ball that can predict the future, but a method to make educated guesses based on available data. DCF analysis is a powerful tool in gauging a company's intrinsic value, but it is crucial to be conservative in your estimates. Now that we have a basic understanding of DCF analysis, let's see how to perform it. The first step in DCF analysis is determining the company's free cash flow. often abbreviated as FCF. Free cash flow is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. It's the cash that's freely available to be distributed to all stakeholders of the company. You can find the free cash flow information in the company's financial statements. However, if you prefer a more straightforward approach, you can use online platforms like Yahoo Finance or Morningstar, which provide this data in a user-friendly format. The second step in DCF analysis is choosing an appropriate discount rate. This is usually the company's weighted average cost of capital, or WACC. WACC represents the average rate of return a company is expected to provide to all its security holders, including debt holders and equity holders. It's important to get this number right, as it is used to discount future cash flows, and a small change can significantly affect the final valuation. Now, while the concept of WACC might seem intimidating, don't worry. There are plenty of resources that explain how to calculate it in a simple and understandable manner. Websites like Investopedia offer comprehensive guides on this topic. Finally, once we have the free cash flow and the discount rate, we are ready to perform the DCF calculations. If you're not comfortable doing these calculations manually, there are tools available that can help. Websites like Investopedia offer easy-to-use DCF calculators. Alternatively, for those who prefer a more hands-on approach, Excel templates are available on sites like the Corporate Finance Institute. These templates allow you to input your numbers, and they do the calculations for you. Performing DCF analysis might seem complex, but with the right resources and practice, it can become second nature. And remember, DCF is not just a mathematical exercise, but a way of understanding the intrinsic value of a company. So keep practicing, keep learning, and soon you'll be a pro at performing DCF analysis. Finally, let's talk about how to combine these methods for accurate valuation. Picture this. You've done your stock research, you've engaged in exhaustive peer analysis, and you've even dived into the intricacies of discounted cash flow analysis. But how do you bring it all together? Well, the key is to use each method to its advantage. Peer analysis, for instance, helps you to gauge market sentiment and industry standards. It's like taking the pulse of the market, giving you a feel for how your chosen company stacks up against its competition. Then there's DCF, offering a unique perspective on intrinsic value estimation. This isn't about market trends, it's about the fundamental worth of the company, based on its future cash flows. By combining these methods, you can get a more accurate picture of a company's value, helping you make more informed investment decisions. But remember, this is not financial advice. Always do your own research.